Kia ora, and welcome to the CoreLogic Property Market Update for Hui Tanguru, February 2023. The property market has started the year sluggishly. After closing out 2022 with fewer than 64,000 sales in the year, the lowest volume for a calendar year in almost 40 years, 2023 has begun even slower. Less than 3,000 properties transacted in January, including those sold without an agent involved. While we know January is always a seasonally slow month, we simply haven't seen sales activity this low through the month of January previously. Not even in the years following the global financial crisis or any of the economic crises back to the 1980s. In fact, the only month on record where fewer sales were recorded was April 2020, when we were all in full lockdown. High house prices, after decades of growth, further boosted by the 2021 super acceleration phase, combined with recent and rapid rise of interest rates, have led to severe unaffordability in many parts of the country. When combined with weak consumer confidence, ready and willing buyers are harder to come by. Of course, with prices still falling, down a further 0.3% in January after a 6.1% decline in the second half of 2022, some affordability measures have started to improve, but from a very high base. It will take some time and probably needs to be combined with stabilising interest rates to provide any sort of noticeable boost to demand. The major headwinds here are the risk of a recession and rising unemployment in the near term. Multiple property owners requiring a mortgage have been the most impacted, as seen in the CoreLogic buyer classification series, where the already lower share of purchases at 21% in the final quarter of 2022 was gazumped in January 2023 as a historically low 20% of sales by this group. Demand from first home buyers, with greater motivation to both exit the rental market and acquire a long-term retirement asset, has been more resilient, with this group accounting for 1 in 4 sales in January. While first home buyers are proportionally a large part of the market, the reduced overall volume of sales means there are actually fewer successful first home buyers getting a foot on the ladder than in the past. Some of them manage to find a way to make it work, while other buyers find it harder to justify making a purchasing decision in a weakening market amid low confidence. Negotiating power will be helping first home buyers as buyer choice is strong, as will the availability of low deposit loans, lending exemptions for new builds, and access to KiwiSaver funds. Uncertainty and consideration of an upcoming recession will be playing on everyone's mind though, and this will only be exacerbated by the recent weather events to hit our shores. In terms of property, there's the probable direct impact of Cyclone Gabrielle on transactions, with fewer people moving, outside of necessity, not to mention the impact on vendors having to engage with insurance companies for remedial work. This is off the back of the already devastating floods in Auckland in January. I think it's fair to say the impact of the latest climate-related weather events will linger for some time. There's also the impact to the economy and subsequently interest rates to consider. On balance, significant weather events have a stimulatory effect on inflation, as increased spending is required to rebuild, and as certain types of produce are wiped out, such as fruit, vegetables and other crops. However, when considering the next OCR decision, Te Pūtea Mātua, the Reserve Bank of New Zealand, will need to balance the impact of higher interest rates, making it more difficult for small businesses and consumers to access the funds required to rebuild themselves. All that being said, Te Pūtea Mātua is likely to opt for a 50 basis point lift at its next meeting on 22 February. This is slightly smaller than previously expected, but seems to be the popular view across economic commentators, given most of the recently released data has been good news when it comes to the inflation outlook. The official CPI inflation data for Q4 came in at a 7.2% annual change, still high, but lower than Te Pūtea Mātua expected, at 7.5%. The Aotearoa labour market softened, with the unemployment rate rising to 3.4%, from 3.3% previously, possibly providing early evidence of a future weakness. And perhaps just as importantly, their own survey of expectations showed a minor drop in where inflation could be in 2 years' time, falling to 3.3% from 3.6% previously. You could even add the continued property market weakness to the body of evidence Te Pūtea Mātua will use in their decision, as further falls in values, as we've witnessed and expect more of, will perpetuate the tightening of homeowners' belts. especially when combined with the size of mortgage rate changes for those coming up to renew their fixed terms in the next 6 months. Further tough times ahead then, but the hope remains that things should start to improve by the second half of the year. Recovering net migration remains one variable to keep an eye on in that context. An intriguing few months to come before then though, so make sure you keep up to date with the latest property market data and insights via CoreLogic NZ on LinkedIn, Instagram, Twitter or Facebook, and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.